Hello, everyone. Welcome to another Future is Blue video talk. And let me remind you that this is an initiative promoted by Agenda Pública and Funcas Europe. And today we're going to cover state aid because we're seeing more and more member states in the EU helping those businesses that are so badly hit by the COVID crisis. So governments are injecting money, are helping those businesses to stay open. And to see this crisis, to let this crisis go behind. So we're going to see at what's working, what's not working, what are the implications of state aid in the EU as a whole. And we're joined by two great analysts. And let me introduce you to Peter Bofinger, Professor for Monetary and International Economics at Würzburg University. Thank you for joining, Peter.
Oh.
And joining us as well today, Raymond Torres, Funcas Europe Director. Hello, Raymond.
Hello.
All right. So, Raymond, perhaps we could start, if you could tell us briefly about what's happening in Spain now, because the government just recently approved a package of 7 billion in direct aid for struggling businesses. And these are, as I understand, these are non-refundable payouts. So what's behind this initiative? Could you tell us a bit about it?
Yes, in fact, the government has launched a program worth 11 billion, including 7 billion for direct transfers and then another 4 billion with debt restructuring support, as well as a new initiative to inject equity into travel firms. The idea here, as in other European countries, is that as the crisis goes on, there's a risk of bankruptcy, of insolvency, of even viable enterprises. And so the government is worried and knows that the support which was provided during the first wave with short-term work schemes, as well as liquidity injections or support to get loans, cheap loans, is not enough, is not working in a situation where many firms are over-indebted already. And so this is why the Spanish government, after a good while of pressures, is launching this program, which already exists in other European countries, already from end of 2020 or beginning of this year.
All right, thank you, Raymond. I think, Peter, in Germany, you've taken, the government in Germany has taken similar initiatives over the last months. Is that right?
Yes, of course. I think you can categorize the government measures in 4 categories. First is liquidity support. Second is equity, solvency support. The third is demand support, that is somehow try to stimulate the demand. And the fourth one is also some kind of transformatory support, so helping companies during the crisis not only to get back where they started from, but also to have some kind of transformation. I think these are the 4 categories, and in all the 4 categories, the German government has been very active. I think one of the most important programs is what Raymond said, is this short-term time work, which really is a relief in terms of liquidity and in terms of solvency. You don't have to pay wages. And of course, it's also some kind of support for overall demand, because people, instead of being unemployed, they still get a relatively large part of their salary. So short-time work is really something that matters. Then we have also a vast amount of government guarantees provided by the Kreditanstalt für Wiederaufbau, some of them with 100% guarantee of the government, so that the banks get not involved in risk. Then in terms of solvency, we got direct transfers to self-employed people. We get now a relatively broadly based support for companies, covering their fixed costs, and in some parts companies also get a part of their revenues supported by the government. And also for the large companies like Lufthansa or so, there's also this kind of direct equity support. And then, of course, as far as demand is concerned, we had a reduction of the value-added tax in the second half of last year, and we still have a lower value-added tax for restaurants and hotels, who of course suffer most from the lockdown. But of course, they first have to be opened again because they can benefit from lower value-added taxes.
Quite a comprehensive package and different measures. But one of the key things here, no matter if we're looking at Germany or Spain or so many other countries, is how governments make it right in terms of targeting the right businesses. This is not only about identifying those businesses that are struggling, which may be easy to identify. Most of them are having difficulties, but rather, how do you make sure those businesses are not going to close in a few months? How those businesses are those businesses relevant for the world after COVID? Are they going to be productive? Is it worth spending the public money in those kind of businesses? So what are your thoughts around this debate? Raymond, what is your take on?
Yes, I think there are two big risks here. The first risk is, in a way, not doing enough, in the sense that if you don't support enterprises which are facing constraints imposed by government for good reasons, because of course we have a health crisis, then the risk is that these enterprises simply close down, and then people are laid off, even though there may be a recovery later on, and these enterprises would have an actual future, they would be viable. So this is the first risk. But then the second risk is what you say, Carlos, which is that in a way, it's not that you can do too much, it's that you may not use the right instrument for the right situation. The key thing here is, or would be, to only support viable enterprises directly, and those that are really unviable, undertake restructuring. But the real problem here is that in many cases we don't know which, for example, in the tourism sector in Spain, who knows which hotel is going to be viable after the health crisis is over, if it's ever over, or is not viable. It's difficult to detect. So in a way, the crucial thing here is, in those schemes that also Peter has mentioned, is create incentives little by little, so that as time goes, it is possible to identify a bit more easily which enterprises are viable and which are not viable. And so I think this is, in a way, the challenge which all countries are facing. In a way, Germany has a lot of funding, so this is less of an issue in Germany, because it can even support zombie enterprises. But in countries like Spain, it's even more important to introduce those incentives so that you are able to isolate, to identify the viable ones and really focus on those.
Peter, what is your reaction to that?
Well, I think I agree. And of course, nobody really knows which hotels might be viable after the pandemic is over. Maybe there are some hotels relying on business travel, business meetings that will not be viable, but we don't know it. And I would say the benefit of doubt should be to support companies, because it's not their fault. I think the lockdown is something that has been decided by the government. And so I would say the government has a responsibility to give them a chance to survive. And of course, in Germany, it's easier because our financial constraints of our government are much lower than other countries. So we have a debt to GDP ratio that is now maybe around 70%, only 10 percentage points above the 60%. So we have a huge fiscal space. But nevertheless, I think overall one should try to be generous. And of course, we see here a general problem of the European Union, of the euro area, that the fiscal space for the whole currency area is relatively limited, much more limited than the case of the United States. And one can see that. There are data from the IMF who show the support that has been given from the government to the private sector. And there's a huge difference between the support provided in the US and the support provided in Italy or Spain, which is relatively low. And of course, there are these financial constraints. And of course, then one has to ask, is the joint funding that we have reached so far, is it really sufficient given the length of the pandemic? And I think we need a second initiative trying to get funds just to help governments to keep the economy alive. But asking about the instruments, one sentence. So my favorite instrument is the loss carried back. That's something we have in Germany, and it has been extended by the government. And I think, and if you look in the US, they have loss carry backs up to 5 years. In the UK, they have loss carry backs up to 3 years. And the advantage of loss carry back is that you somehow support profitable countries, because if you have made losses already in 1919 or 1918, you do not benefit from it. And so I think loss carry back is something which I really would recommend. And as far as I know, you don't have it in Spain. I think you can take losses forward, but carry back is because it's administratively easy. It helps the companies. And only if you have been profitable in the past, you can benefit from it. So it's not a kind of instrument that keeps zombies alive.
I wanted to ask you about something that Peter mentioned. He said in Germany, we don't have such a big constraint, or we have, obviously there's a fragmentation when we look at Europe and see what governments are doing. Each of those governments have a capacity that is, that depends on their size, on their savings, on their financial strength. So what are the implications of seeing this complex map of some member states having more capacity to support businesses at this very moment? So when we look at the day of tomorrow, when this pandemic hopefully is going to be over soon, what are the implications of having this approach where, yeah, Peter mentioned the US on the other side, and I will ask you about this afterwards, but exactly, the US has one financial bazooka pointing to all businesses, and here we have this fragmentation. So Raymond, why I think this is concerning, but why is it such an issue?
Yes, I will respond to that in a moment, Carlos, and only to just a follow-up footnote in a way to what Peter said about loss carry back. It also, there is something similar to this in Spain, but in the past, the problem is that this has been criticized on the grounds that it was used sometimes as a way to pay less taxes. So, because it could be spread for a long period of time. And in the end, so I think, although I think it's a very attractive instrument for the reasons you say, Peter, I think in the case of Spain, it would need to be used with care and putting conditions there so that at least there is a minimum tax payment, you know, or something like that sometime in the future. At least, well, I can say that in the past it was used and it had to be reformed in Spain as a result of this. So I think what you say, maybe to concentrate on what happened in 2020 and only to provide this to those that made profits before 2020 would make sense as a first, you know, as a condition. In terms of the space, what you say, Carlos, I think that I think this is a real issue in Europe. I mean, there are two problems. One, what Peter says, that maybe in the end, the European Recovery Fund, which was conceived in July last year, was perhaps enough at that time, but in the end, we are seeing that the crisis is taking longer. We have a third wave of infections and perhaps even a fourth wave later on. We hope not. The vaccination process campaign is proceeding slowly compared to expectations. So, I mean, ideally, one will need to think perhaps a second round, but I expect that there will be very little appetite and it will be very difficult to engage in a second round. So my suggestion would be to revise the fiscal rules. At the moment, they are just, in a way, postponed, those fiscal rules, but either postpone even further, or revise them in order to allow some fiscal space, in particular, in those highly indebted countries, partly because of their own mistakes of the past, and partly because the crisis has been asymmetric, has affected more, let's say, tourism-intensive countries than others. So the reform of fiscal rules will be a very important way to handle this problem of lack of fiscal space in crisis-hit countries, those particularly hit countries.
So postpone and reform fiscal rules.
We need fiscal rules, of course, but simply reform them.
What do you agree with that idea, Peter?
Well, I fully agree. I think the 60% debt target of the Maastricht Treaty is completely outdated. First of all, it was never a reference value that was derived from some kind of scientific framework was just the average in 1990. So if you take the average in 2020, it would be close to 100%. So it's the same justification. And if you look at the debt levels in the United States, in Japan, I think 60% do not make any sense any longer. And it would be really dangerous to have the 60% as the anchor for the whole fiscal framework of the euro area. So I think that's lacks any scientific evidence. And I think if we derive very stringent measures from such an anchor, the anchor should be an anchor that is solid in terms of academic qualification, and not just a value that somehow was taken in 1990. And I think here we have to start, and we have to start a very comprehensive discussion. And hopefully also in Germany, we will see more flexibility, because also in Germany, we begin to realize that with this very rigid debt brake, which says more or less no government deficits, we will not survive the next few years. Because in Germany, also, we have been quite successful in the past decade. I think we are now confronted with a huge transformation that is not only Corona related, but it's the digitalization, the decarbonization. There are completely new trends in the automotive sector. And so Germany is confronted with what I would say disruptive processes. And if you want to deal with these challenges, I think this very tight black zero debt brake framework will not be adequate. And I think people are realizing it slowly. And I think there's also some flexibility now coming up. And that would then also have positive implications for the whole discussion at the EU level.
I wanted to move on and ask a final question about the US, because when we look at the other side of the Atlantic, whether if it comes to the number of vaccines that they actually have, that they are actually distributing, and what's happening on this side of the Atlantic, particularly in the EU, not so much in the UK. There are some interesting signals, but also when we look at the package that the US has just approved of, I think it's $1.9 trillion. What's the lesson for Europe, looking at how we are coming out of this crisis and how the US is coming out? Because the indicators, growth indicators and so on for this year are very clear. The US is managing this crisis better. So I know we're not exactly one country. The situation is rather complex on this side, but still, I wanted to ask you, what are the lessons we could learn from both experiences? Raymond.
Well, I think that what I would say, there are some positive elements on both sides. I think that what was most positive in the case of Europe was the short-term war schemes. I think this is something which was used much less in the case of the US. And those schemes were pretty much institutionalized in many European countries already. So it is true that once you have, for example, the Kurzarbeit in Germany exists for many decades. But in Spain it is newer, but at least it existed. So I think this has been very positive, and the result is that it has reduced the pain, both the social but also the economic pain. It has also had some advantages from the economic point of view. On the US side, the key advantage has been the fiscal flexibility. They're able to react very quickly and massively, even if necessary. They do whatever it takes in a way from the fiscal point of view. Whereas in the case of Europe, it's just very complicated. We managed to get an agreement in July, but you can see that, in my opinion, you will need to be flexible with that agreement, but nobody really wants to open up again the discussion because it's probably very difficult. And so I think combining both, the virtues of both would be the ideal.
Raymond, if you open up that instrument now, they're gonna kill you, because it took so many months in the EU machinery to put that on track in the EU Parliament, with the Council, the trialogues. It's so complicated that it makes total sense. But on the other hand, our rhythm is rather slow in that regard. So
Totally. Yes, I agree that it's not. So probably that's why I'm saying that maybe one way would be to, you know, start to kind of front load much of the programs as much as possible, because we need this year and next year in particular fiscal policy. In 2023, maybe the European economy is growing and we'll need a different type of fiscal policy. Whereas now is when we need some fiscal support for the economy. So front loading would be one way of adding a bit of fiscal flexibility.
Peter, any thoughts on the divergence when it comes at both sides of the Atlantic and how we are coming out of this crisis?
Well, the lesson could be that if you are more centralized, if you are more integrated, you are in a much better shape to deal with severe crises. I think that's what you can see. And I think it's with the vaccine situation that, of course, the US had one agency that very early started to deal with this ordering vaccines. And I think in the EU, we had the problem that so far, that until the crisis, health policy was a national issue. And so at the Commission level, there was not a strong unit having experience with health and vaccinations. And so in my view, the lesson would be we need more centralization, we need more integration also in terms of fiscal policy, because otherwise, I think otherwise there is a risk that in major countries, people will say, let's do it by ourselves. Let's not rely on the EU. The EU is not able to deal with such situations, and so we better do it on our own. Look what they've done in the UK. So that could be a risk. No? That if we do not have more decision-making power in Brussels, and of course we need also capable people sitting at the table, and then we could achieve more.
So it's interesting because it's either we get more integrated, or there are going to be more and more people saying this is not working, this is not worth it, let's have it our own way because the UK just left and they are doing the vaccine so well and so on. And the US as well is injecting the money more efficiently with one. Raymond?
Yes, I completely agree with Peter, and would say that this is why, I mean, is it because we need more integration, but at the same time, the present type of integration doesn't seem to be always working. So with the vaccine, it's going to be very difficult to convince people that we need more integration in Brussels, where you sit now, Carlos, if Brussels does, in the end, does not do a good job. So I think it's extremely important that both the vaccine process, is repaired now and works better. And also, I think this recovery fund, this European Recovery Fund, it is vital for the future of Europe, in fact, that it works properly. Because it's not just a question of economic recovery, it's also a question of providing the argument for those that want more federalism, if you want, in Europe, a more integrated approach in Europe. Because if it doesn't work, I don't see, the argument would be very difficult to make in the future.
Yes, I agree. And I think so. Getting vaccinations right and getting the EU funds right to get out of this crisis. I was going to say stronger, but I wish the word would be stronger. But there's so much at stake for the EU integration. Peter, before we close, any final thought?
Well, so as you said, so there is also a chance that Europe will come out of the crisis in a better shape. And of course, it all depends what's happening in the UK, because so far the UK looks good because they are successful in vaccination. But if you look at economic data, yes, in the UK, they are a disaster. And so I think maybe 1 year later, if the COVID pandemic is over, and then you see how difficult it is in the UK to live outside the EU, that will also help to strengthen the public appearance of the EU and will create more support for the EU than we have today.
So I think this is indeed a marathon, and we may think this is over, but it is not over, and we'll see how things look like when this is really over. Yeah. But great analysis to see what's happening right until now. So let's organize another video talk in a few months when things look more, hopefully the pandemic will be, I'm not sure if it's over, because this concept of being over is going to be quite rather not black and white, but definitely when things look better. Raymond Torres, thank you so much for joining us today.
Thank you very much. It was a pleasure.
And Peter Bofinger, Professor for Monetary and International Economics at Würzburg University. Thank you, Peter.
Thank you. It was a pleasure.